Welcome to the Gray Report. I'm your host, Spencer Gray, and if you're a multifamily investor, whether you're active, passive, or you're just thinking about it, well, this is the show that we've designed especially for you to keep you up to speed with all of the most important research reports, data points, articles, and then some original opinions from the Gray Capital team to give you all the best information so you can make some really informed and smart investing decisions. A lot of great reports today as we are just diving into a sea of uncertainty as we have for the last month or so, or 6 months here at the Gray Report, but reports from Globe Street, Colliers, Apartment List, RealPage, and ADP. I also want to talk about some of these investor anxiety that's going on right now. Had some really good calls with some of our investors and then just talked to other operators, syndicators on what they're hearing. And it's really interesting, not too surprising, but I want to get into it and talk about some of the differences that different multifamily operators and syndicators, the different approaches that they've taken over the last year or so and the different positions that they are in now. Some are going to in a good spot. Some are feeling the pain with rising interest rates. Let's get into it. All right, bringing it back in, Matt Bosnagel, Director of Communications and Marketing here at Gray Capital, back in the saddle after being out cold last week, being sick. I've been sick, then you were sick, all of our kids were sick. Yeah. It wasn't the same doing it without you, Matt. I'll be honest. Getting ready to do it by myself, and I was like, "Oh, this is going to be a shorter video." Fortunately, we had Addison that was able to hop in the seat, and I think he did a great job. Yeah. We got a comment. I said, "Addison, your bonus is kind of on the line here to get this through, get this right." And we've already got a comment saying he should get his bonus. So Addison's getting the end of the year Christmas bonus, and
he's strutting around the office like a diva now.
He is. He's like, I'm on the LinkedIn. I'm on the YouTubes, I'm on the Facebooks, and AOL, wherever you're getting your content these days. But people are consuming it, and people want more ads, so we might have to have him back on. Not related, but I'm just saying.
No, that's
bring
fine.
Him on, special guest. Matt, how's your week going? What is new with you? You're better. You're feeling better.
Yeah, feeling better.
Finally,
it was nice to get back into things. Wasn't too unfamiliar getting back into the swing of things. I'm definitely refreshed, and I think that there's a lot of. I think we got our work cut out for us. Mm-hmm. I think you've referenced this before, but I am kind of interested in the changes that really I've been starting to solidify in terms of people's sentiment. Yeah. And in terms of, I want to know what investors are thinking and what are the concerns that they're bringing to the table. And specifically, I want to know how you respond to them. Yeah. And do you say, "Nah, you're wrong," or do you acknowledge? Which I'm assuming that you acknowledge them. And then my biggest question there this entire week is, where we go from here. Mm-hmm. I don't like the idea of waiting and seeing. So if we are going to take an action, what is it?
No, that's a great question. I think a lot of it is kind of parsing out the short-term uncertainties versus the long-term of things that we have a high probability of relative certainty about. Yeah. Like for example, in let's say in 5 to 10 years, do we think average apartment rents will be higher or lower? Mm-hmm. I'd say with a great deal of certainty, near 98, 99%, rents are going to be higher still in the 90s, significantly higher in 5 to 10 years. Yeah. Now, where are cap rates going to go in that same period of time? That's a much more uncertain question because there's so many more variables that go into it that we're dealing with right now. So if you have but it comes back to kind of duration, time horizon, and it also comes back to why we have kind of structured our investments the way that we have. We've never taken a absolute short-term view of we have to turn this property around in 24 months or 36 months or even 4 years. Mm-hmm. We want to give ourselves the opportunity to minimize downside to as lowest probability as possible. Yeah. And one of the two main ways that we do that, there are many, but the two main ways, I'll just throw three in. One is buying right. Mm-hmm. You can do whatever you want, but if you've overpaid, you're just going to be digging yourself out of that hole for the foreseeable future. The second is having the option for a long-term hold and a long-term time horizon. Mm-hmm. Now, that's why we put long-term debt, typically 10-year terms, up to 35-year terms.
Yeah.
Like, we've got some deals where we don't have to refinance or do anything for 30 some years. Well, now we're probably not going to hold it for 30 years, but if we wanted to, we could. Like on one deal, we've locked in a 2.9% rate for 35 years.
What is the cost? That was what I was wondering, because surely that there is, when you started to think about this long term, there was probably a temptation to take it short term.
Yeah.
But what are you sacrificing by taking that long term?
That's a great question. So it's a good point, because we fixed some of this debt, we do limit some of our upside. So let's say the market turns around and just cap rates drop, because interest rates drop, and things are going gangbuster next year or 2 years from now. Mm-hmm. Some of our loans will be difficult, or some of the properties may be difficult to sell because we have a prepayment penalty. Now the price could be to a point where it makes sense, or someone could assume the loan. But there's a good chance that we may not be able to sell some of these properties in 2 or 3 years because of the prepayment penalties. Mm-hmm. So, and if you could sell in 2 or 3 years, that IRR, because it's a time adjusted, time weighted metric, it goes way, 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 way up. Now your equity multiple may be way lower, but if you turn something around in 2 or 3 years, you're looking at potentially 30 to 40 IRR if you do a gangbuster job.
Yeah.
We've done those deals, and that can happen, but you need to turn it around pretty quickly to get those really high double-digit IRRs.
Okay.
So we are foregoing the possibility of we're going to not just hit a home run, but a grand slam in 2 or 3 years. But we still have the possibility of hitting a home run, but it may be in 5 years.
Yeah. Okay.
And so we've reduced some of our upside, but we've traded that reduction in potential huge upside, and really only on an IRR basis, not on a multiple basis. But we've significantly limited our downside. We've made the chance of success incredibly high. Only possible with the kind of the third thing that we do, which is bring on significantly more reserves than is typically done.
Okay.
I've heard people say we bring on a year's worth of distributions, or an X percent of our equity or CapEx. Some people just bring in just the money for your CapEx and no reserves. I've seen some operators bring in essentially no reserves outside of the replacement reserves that they are required to deposit with their lender. And they're saying, oh yeah, we've got a reserve account. Of course we're putting reserves away. Well, you're putting $60 per unit per month away. It's not going to be, you're going to build up that account over time. Maybe you have to fund it at the beginning. But you're talking of funding in the $50,000, $100,000, $200,000 range, where we're bringing $1 million on of cash. Some maybe allocated for CapEx, but significant amount of dollars per unit, not 50 or 100, 200. We're talking more of the couple $1,000 per unit. So we've got projects where we're all right, we're still seasoning. We need to get it through this next year because we're in a lease up and a rebrand and all of that. But we're not worried that, we need this to happen in 6 months, otherwise we're going to lose the investment. Yeah. Because we've got cash to carry the property for a year plus, maybe 2 years, which that won't be necessary, but it certainly allows me to sleep well at night, our investors to sleep well at night. Yeah. And so back to your question about investors and their concerns, we've been getting some feedback from investors. Not really on our deals, but they're working with other syndicators and sponsors, and they're saying, they're suspending distributions. They don't have the cash on hand. They've been buying all these assets with floating rate debt, and they've got caps, and maybe they're not going to be paying any more in the future. But their interest rate, they thought they were going to be paying 3, now they're paying 6. Yeah, it's capped at 6 now, but your interest payment is doubled. Yeah. But not only that, you have to escrow a certain amount of money for those interest rate caps to purchase another cap in 3 years or whenever your cap expires. Because the caps, which is an insurance product, it only is good for a couple of years. Oh, okay. And basically the way they work is you buy this cap, which you have to pay a lot of money in today's market to buy, which is essentially an insurance product that, if interest rates cross this line, we're going to actually start paying you some money because your interest rate has just crossed this threshold. Okay. But at the same time, they're saying, well, the requirements of the loan is that you always have to have a cap in place. And we want to make sure you have enough money to buy that next cap when it expires in 3 years. So, in order to do that, we want you to set aside money, put it in an escrow account to save up for that cap purchase.
Okay.
And so as interest rates have continued to rise, that amount that they have to escrow has risen. And a lot of operators didn't realize that, because when they got their quote, when they were buying it, they're like, yeah, your cap's here, here's your strike price, here's your duration, and here's your escrow amount. Let's call it, I don't know, $5,000 a month or whatever.
Yeah.
Just picking a number. Now that the forward curve has gone way up because everyone thinks the Fed is going to continue to raise rates.
Yeah.
All right. Well, now your escrow is going to be $15,000 a month.
Yeah, that's...
And your interest rate has increased.
It's interesting to put yourself in those shoes, though. If you were, maybe a couple years ago, or maybe even just a year ago, what were your assumptions? Did you? I think that we were a little bit where people say inflation and interest rates in the same breath. We were talking about inflation last year, and it was hard to that's just such a difficult decision to make.
Well, nobody knew.
Yeah,
I mean, we were looking around. We're like, inflation isn't going away tomorrow, because just not being classically trained economists, and we're just we play one on YouTube, and but looking at it and seeing like, all right, well, all the price of these things are going to rise, but that's going to make the price of everything else rise, and then everyone's salaries are going to have to rise, and then rents are lagging, like the market rate's rising, but the actual people are paying are going to be just slower tick up, and then people are going to need to ask for a raise because the rents have gone up, and it's like, all right, are we going to have high inflation for the next decade? Probably not. Maybe. Probably not. But it wasn't going to be transitory 6 month, 1 year, like was sort of consensus in what the Federal Reserve and central banks thought, last year, when they were still, doing quantitative easing.
I think all of those solutions that you talk about, whether it's buying right, having the relationships with the sellers, and with brokers to be able to kind of know the market, and being able to get long-term debt, and then maybe even especially to bring on additional reserves. There are a lot of it has to do with scale, and if you don't have that scale, then it does seem like it would be a bumpy road in the next year or two.
Yeah, because let's say you're syndicating any type of commercial real estate deal, and you're having a hard time raising money, and you need $5 million to close, to bring to the closing table.
Yeah.
But typically, the money you have to raise is a decent amount in excess of what you have to bring to the table, because you need money for your CapEx plan. You need money for reserves. Most of the time, there's some fees associated with the deal, like an acquisition fee. You have to raise that money out of equity. And a sponsor who may have difficulty raising capital right now, which, by the way, everyone's having a hard time raising capital right now for all the reasons what we're talking about. Yeah. All of a sudden, they're like, well, I want to buy the property because I've got hard money on the line, non-refundable earnest money. And, well, I've got the $5 million to actually close the deal, but I don't have the $6 million that would include my fees and reserves. Yeah. And so then the sponsor's going in, hungry. They're not making any money now, which is fine. They couldn't raise all the money to pay themselves, I guess. But that changes the way they're looking about the deal. Yeah. They're trying to recoup that at some point. And then if anything goes wrong, all of a sudden something breaks that's below your deductible, or something that just insurance doesn't cover, or whatever. You don't have any money if anything goes wrong. That's what
I keep thinking of, is like, if you don't have the money to make, and I just think of it in simple terms, to make a repair, then if you're not prepared for that, then that gets really expensive. It seems like it's almost like you're buying a nice pair of boots that'll last you 10 years, or you're buying a new one every winter. Yeah. If you're back against the wall, then you maybe are going to take cheaper short-term solutions because you just don't have the capacity to make long-term.
And I think that's exactly is what happened when people were being led to just like, I'm going to use a bridge loan, and I'm just going to use floating rate debt, and I'm going to buy the cheapest cap possible because screw this, inflation's going to be transitory, rates aren't going to go that high. In March, I was looking at the dot plots in the futures curve, and I'm like, the Fed funds rate could easily be 5%. Like, that's what they're saying it's going to be. Not that at that point, I'm like, I don't know if that will happen, but what if it does? And I remember talking to some other operators and syndicators, and they're like, yeah, They're like, but the floating rate just it looks really attractive right now. So I can get the proceeds and the interest rate's lower, and I have the flex. The big huge advantage of floating rate debt, and it's so enticing, is the low prepayment penalties. The lower prepayment penalty. And they're like, well, I want to hit that 50% IRR in, a year and a half. I just want to crush it. And so they're like, I'm going to lock it up, because part of this is very true. There's risk in not being able to sell.
Yeah.
What if the best time ever is to sell 2 years? Well, we can't do that.
Yeah.
But if the market goes the other way, we don't lose any money. They may lose everything.
Yeah. Yeah.
And I refuse to open that up. And then if that means limiting upside, I'd rather crush a 2.5 over 5 years or 3x over 10 years and miss out on the maybe 2x in 2 years.
Yeah.
And again, it's trading time. And I like the idea of low high speed, low drag is cool. But the managing other people's money, it's a huge responsibility. Yeah. And it's like, my goal is like, I want to win every time.
Yeah. Yeah.
I don't need the 5x.
Yeah. It's certainly a less stressful, and even just the sentiment of the market. We were saying, even when things were going great, it's a little too exciting. It's a little too overheated. And on the macro and the micro scale, you can't, it just seems like it's not my life. I'd rather it have certifiable success that you work hard and do than aim to get lucky every time.
Yeah, exactly. We're investing. We're not gambling. We're not rolling the dice. And that's what I love about multifamily is that if you are okay with a longer term horizon, you are gonna make money and be successful.
Yeah,
it's going to work out if you can give yourself time, use time to your advantage. Instead of having time work against you. I mean, if anyone's ever traded options, like if you know what theta is, you can be right, but if the timing's wrong, your value is eroded just as time goes on.
Yeah.
And it go to zero. You could have made the right call, the right price, but time matters, and it can go to zero just because you got the timing wrong.
So that's what I was thinking too. I was like, what decisions do people make? I'm thinking of markets, I'm thinking of place, but time is so important too. Whether you're talking about the duration of investment or the exact time in which you're going to invest.
But that's the thing, we can't time it. And so it's it's not timing the market. I think it's time in the market. And that may lead to you buying some things at a point in the market of where I think maybe in retrospect, maybe we paid a little bit more for that property. But if you're continuing to stay in the market, you will also pick up opportunities that are well below market and are great deals.
Yeah.
And we're starting to see that happen. The cracks that we've been talking about, Matt, over the last good 2 to 3 months about there's going to be some pressure, especially end of next year, early 2024, when a lot of these short-term loans are going to be coming due. But I'm already hearing about the pressure from other operators, syndicators, and investors, where a lot of these floating rate loans, the interest rates have gone up, the cap escrows have increased, which they weren't counting on. They didn't think that was going to happen.
Yeah.
And now rent growth is slowing, and occupancy is dropping. So they were projecting 10%, 15% rent growth this year, and another 10% next year. Well, you're going to get 7 this year, and you're going to get 4 next year. And their exit cap projections were 3.5% or 4%. Well, cap rates, they're no longer 4%. They're 4.5% to 5%.
Yeah.
So the market has changed, and part of it is it's a healthy sign that the economy is working and figuring things out and is oscillating and resetting. So it's fascinating from that standpoint. But man, I think having a long-term view is the only way. Only way to do it.
Stay sane.
All right. Well, that's a little market commentary.
I appreciate that.
Put a bookend on it, though. I'm sorry. Just one last piece, because I try to use kind of these intros of being like, hey, this is what's going on in real time for just people in the industry or our investors or just partners, colleagues, associates, everybody. It's like we've been working through it all week and every day and having conversations, and I think it's a good opportunity to kind of share what's going on and what our state of mind is also. Because I like to be able to tell investors, like, you can go back for the last going on 2 years now, Matt. Every single you can get you want to know what our thought process was in March of 2021. We'll go back watch all 4 videos going over our process,
Yeah.
or many of the other videos we've done. Let's get into the reports, Matt.
All right.
Get into the hard data. We want to start with ADP or Globe Street? Where do you want?
Yeah, let's start with ADP.
Jobs report.
You kind of brought this to my attention. ADP has their employment report that was released for November, and the Labor Department is going to have one in a couple days, but we're getting some jobs numbers.
Yeah, typically the ADP is like the unofficial report that comes out like right before the official report, and so people are like try to compare the two, and like you get the ADP, you can kind of jostle for when the official one comes out. Yeah.
Oh, that's funny. So yeah, as you see on the screen here, we added 127,000 jobs last month, which I looked at another source. That's well below estimates. The Dow Jones was estimating 190,000 jobs added specifically, and like I said, the Labor Department is releasing their own numbers, and the expectation for the Labor Department numbers is about 200,000 jobs added. But if this ADP jobs report came in under expectations, there's a possibility that the Labor Department report could be below what's expected as well.
Yeah.
And I like that quote that you have highlighted up there too, from the economist Nella Richardson, the chief economist at ADP, says that turning points can be hard to capture in the labor market, but our data suggests that Federal Reserve tightening is having an impact on job creation and pay gains. In addition, companies are no longer in hyper replacement mode. Fewer people are quitting, and the post-pandemic recovery is stabilizing. Now, that's kind of the vibe I got from this jobs report, and we were talking about this beforehand. It's not a worrisome sign of overheated growth, and it is this weird situation that we've talked about many times about how you don't want the economy to grow too much, because then you're going to get higher interest rates. And all of a sudden, it's almost like you're cheering for job losses. But I think that, there's at least the silver lining in this lower than expected jobs report is this cause and effect. I want the Federal Reserve to think that their actions are having a consequence and not keep cranking things up.
Yeah, well, it's a double-edged sword. The good is bad, bad is good. Yeah, and I think of a lot of Eastern philosophy, like yin and yang and balance that goes on, and then I think of the classic Modest Mouse album of good news for people who love bad news. Which did you know that 99% of Google users like this album, Matt?
Oh, that's great.
Yeah, according to Google. But it's so true, because a weak job report, people were hired, more people were fired, is actually kind of good news for investors, because maybe it doesn't give the Fed the ammunition to continue to raise rates or keep rates higher for longer. It's a sign that, okay, what the Fed has been doing is having some effect. And anecdotally, which does show up in these job numbers, apparently, you are hearing a lot more headlines for people being laid off, kind of in general across the board, or it started in the tech industry, and we're seeing it going across to other industries, which is exactly what the Fed wants to see. They want unemployment to be a little bit higher, the economy to be not as hot. So this is good news for us people who like bad news, in terms that, okay, maybe we'll see a little bit of softness.
It still seems like we haven't felt enough pain, and unfortunately, because people are still spending. There was like these preliminary assessments of holiday spending, I think inflation adjusted, it was still like a little under previous years. But if not adjusted for inflation, we've had these record spending, and people are still confident enough that they're putting their money on the line there, and the economy is still quite active, I think. So I think that there's some ways to go, but if we could keep dialing it back a little bit every time, that's a lot more easy for people to get used to.
People are making more money. I just jumped into this job report a little bit this morning, and I think like on raises, people are getting about 7% more money, which is good. People who are switching jobs, getting new jobs, talking about 15% range raise on average. So maybe people are feeling good, people who still have jobs. We're also still coming off of 2021, which was like, fever dream of like, oh, everything's great, everyone's making money, my stock portfolio is, gone way up. And now I think if you're in the weeds and like you're looking at your stock portfolio every day, you're not feeling the same. But I don't know. There's some people who just they're kind of slow to pick up that things are changing and things seem to be fine and like. I'm not going to have a smaller Christmas than I had last year. Now, some people don't have there's no choice. It's like I've got X to spend, and things are more expensive, and my salary hasn't gone up because I haven't changed jobs.
There was a lot of people, I'm sure, that this recovery has passed them by, and I'm guessing a lot of them are the essential workers that never really had a break from the pandemic. So I'd be very interested to see how that kind of pans out on the lower income quartiles, especially one of the 100,000 jobs were lost from the manufacturing sector in this jobs report. But that's also joined by about 100,000 jobs collectively in like the information and business services sectors. If you kind of combine those, so it's a little bit of the offers.
And hospitality continues to come back. Also, I think there was like a 200-some thousand job gain.
The hospitality one, that does seem to be the sector that is doing pretty well. Hospitality, and a little bit less so, but still there is education and medical services were recording some regular gains. Not gangbusters, but doing pretty good.
But I mean, here's again, like on many metrics, the economy is like doing really great. But not at the same time. I mean, we've gotten all the jobs back that we lost. But you can see this curve is starting to flatten out a little bit. The slope is not 45 degrees anymore. It's, I don't know.
Well, and it's interesting just looking at that line graph of jobs. There was a steep run up in jobs before the pandemic. This was like in late
2019.
Yeah. And then it came sinking back down. But I know we've talked about this before about how some people were saying we were getting ready to teeter into a recession in 2018, 2019. There was a yield curve inversion. There were some expectations there that things were running too hot. So
I mean, the pandemic was like everyone's like, we're absolutely going to have a recession. Same talk as like we're having today. Maybe a little less certain, but it was we're going to have a recession. And then the pandemic happened. We had a recession, but it's like and that cleared a lot of things out, but like, was it the real recession that we needed? And then that comes to this idea that, again, it's good news for people who love bad news, but a bad scenario might be that it's like a mild little tiny recession in a blip. Because under that scenario, interest rates may stay higher for longer because you don't flush out all the bad and all the crap. It's like things are all right, and so we really have a stagflationary environment where things just kind of slow down, but inflation is still high, and because the Fed they're not going to lower the interest rate to zero again because if it's not that bad, and so we almost need like a severe, quick but deep recession. To flush all that's the way markets work. You got to flush out all the crap.
Well, and that's interesting that you say that because my fear then is that
it's a technical term.
It's a cleanse.
We have to go through a juice cleanse.
My fear is the Federal Reserve causes a recession that they can't quite reel back in. I think that there is a little bit reassuring that there so far doesn't seem to be like inherent structural aspect of the economy like the housing crisis of 2008 and 2009 that will lead everything falling in on itself. This is the Federal Reserve cranked up interest rates. And that's what we're dealing with.
I think they're partially saying like, they know they're not going to say, but like the goal is to create a recession. Like that's like what the economy needs. And I think that they believe that they will be the white knight because they can fix it by just dropping rates again. And this has been a long process to move the Fed funds rate up to a point where they have the ammunition now to stimulate the economy by lowering it. And they need a kind of a major crash for that to happen. Now, okay, so someone's listening to this and they're like, you're talking about like don't fight the Fed, and the Fed is like trying to cause a severe recession. Why would I invest in like apartments right now or anything? And again, that's where that uncertainty and investor anxiety is coming from. That's where I circle back to saying yeah, this is a 3-6 months, year-long thing. It could be rough.
Yeah.
That's why we're taking a long-term view. That's why we're bringing on reserves. That's why we're investing in markets that aren't being oversupplied, that are a good basis of good value. And the alternatives of going into the stock market, which if you think we're at a bottom now, it's a great idea. But if you think we're going to go into a severe recession that we just described, maybe not a good idea.
Well, and if you think about being reactive to the Federal Reserve, you look at the stock market, and every word it changes. Every word from
say words like
from Powell.
It's like the looks, look that somebody gives.
Yeah.
And so some of the alternatives, I know we're getting a little bit off topic, but it's important. So okay, stock market, there's just inherent risk there.
Yeah.
Again, could you be catching a bottom? Yes. Good luck timing it. And this is all related to timing. Okay. Again, that's why we're choosing a strategy that just uses time to our advantage. You go into bonds because the idea is that if there is a severe recession, bond rates will drop down. Federal Reserve, drop the Fed funds rate. The 10-year is probably going to drop because of the market. But then that's what a bond investor wants to do that's buying bonds right now. They're hoping for that to happen because the value of the bond will increase so much because the interest rate's lower. They've got a higher coupon rate. The value, the intrinsic value of that bond increases. And you could make a lot of money buying treasuries or any kind of bonds right now if you think and if rates do drop significantly. But again, what if this kind of mild recession happens, which is highly probable as well? Then interest rates stay relatively higher, and then you don't get that upside. What if interest rates actually go up a little bit more? Then you're at a loss. Again, there's potential for upside on either of those options. Bonds seemingly like they're safe, but you don't know. Now the bond can be safe if you're okay to hold to maturity, and then you're just going to clip the coupon and be all good.
Yeah,
you clip the 4 to 6%. Then I think that you're missing out on the loss of opportunity for I wouldn't say the same risk because inherently it's not, but a comparatively good a very good risk return balance with much more upside investing into apartments or other types of commercial real estate, specifically apartments, than going into bonds right now. That's like, I'm going to get a 4 to 6%. Don't worry about it. I'm going to be in my triple Bs and maybe long dated treasuries, but you're not going to have any chance for upside in that scenario.
Yeah.
Which I don't think is necessary to take that potential off the table. So
it's very interesting. I think that we're definitely in a new environment. We're beyond the transition point. We're in we're in the alien land.
I think we're. I don't know if we're beyond the transition or not. I don't know because. But we could be.
Yeah.
I think we could be, but I don't think we'll know. I mean, December, and again, some of this is seasonally. Some of this is like, we should have natural decrease of growth in December when things slow down and people stop driving around as much and stop going outside or whatever.
Yeah, that's a good point.
Reasons. But I also think with the Fed's medicine is starting to work in the way that they want. It's just
and that's another kind of hits on the my fear here is there's such a lag time and there's so much momentum that they need to really wait for these previous rate hikes to really see what is really happening because of them. And even if they cut it now, if they decided to put the brakes on completely, we're still not going to feel. There's still going to be a lag to that. Yeah. So in that lag period, that is where maybe things could get different than what they're expecting.
Well, the 10-year Treasury's come down quite a bit since the past couple of weeks. Let's check where it is today. On this November 30th. 2022, just so things are going to change. 3.7, 3.7, which is what's relative these days. I mean, when we're looking at this is like the chart. We've seen it at 50 basis points. We've seen it. It peaked up here at 4%, less than a month ago. Now we're at 3.7. It was 1.9. back in February. So better than 4.3 where it peaked or whatever. But So, but the terminal rate for the Fed funds rates was supposed to be around 5. So, we still have a 10-year Treasury that is lower than where the Fed funds rate apparently will land. So what does that do for the 10-year Treasury? Mm-hmm. Is it going to be under the Fed funds rate? I don't know how often that has occurred.
Yeah, it's kind of confusing.
And that's okay. And that's why we're here to talk about it.
Right.
Because, again, I'm not an economist. I run a real estate private equity shop, and I like to play an economist here on YouTube with you, Matt, because it is a hobby and passion, and but you're a housing expert.
Yeah,
so
well, that's what I'm a little more comfortable with.
Matt is a actual doctor.
But yeah,
housing studies
in literature, but that's fine.
You've read the literature.
Yeah, that's what
it's important.
And this Globe Street article really deals with a lot of the stuff that we were just discussing. I just wanted to note that it doesn't say anything more specific.
Did you write this article?
I know it does seem like
I'm reading this first paragraph, and
oh yeah. I love the way that they characterize this.
Yeah,
the Federal Reserve is like a rare bird in the wild, with armies of aviary watchers staking out a spot and wondering where it will move next. The next big sighting is expected to be this Wednesday when Jay Powell addresses the Brookings Institution. It is like everyone's got the binoculars; they're waiting for like a light on the branch.
Yeah, it's true.
Yeah, the general vibe. Now, this is like
check.
50 basis point increase. That's what the expectation, the hopeful expectation is there. I'm still of the mind that we're still going to see more pain, even if the Fed doesn't crank things up with a 75 basis point increase. That 50 basis point is still an increase, and we're still at a higher Fed funds rate than we've had for decades.
Yeah.
And
the question is, okay, so is the terminal rate going to be around 5%? Is it going to be, could it be above 5%, or are they going to stop short of 5%?
Yeah.
Because that's a big question. I don't think they have much of if they do anything less than 5% or over 5%, 50 basis points in December, they're going to send markets all kinds of signals that I don't think that they want to do.
Yeah.
Consensus is 50 basis points. If they do 75, people are going to say we're screwed, and rates are going to really kind of keep going up and up and up.
Yeah.
If they'll do it 25 basis points, that gives signals to the market that like, oh, we're in the clear, we're all good, we're really slowing things down, and the stock market is going to. They don't want to be playing that, which it's so circular in terms of they should just be doing what they're supposed to be doing, and using the data, but they have to be thinking about the psychology of markets and the psychology of politicians and all of that, and that's where it just, I don't know, not to go down the rabbit hole, but can a committee know what the price of money should be?
Yeah, I know.
Not that they don't do a good job. They're not really smart folks and well-meaning, maybe, probably. But is it possible for just a group of people to determine what the price should be, what the price is? And typically markets decided that or economists usually are like, oh, a market is a good mechanism to decide prices. Yeah. Not a group of a secret group of guys in a boardroom.
A cabal.
Yeah. Cartel.
Yeah, it is interesting, and
it's the banks.
I don't think that there are certain things you just don't have power over, and that's what I am scared is these unintended consequences. They are making things happening in the great machine of the economy, and that machine could go haywire.
Yeah,
it's more complicated than an interest rate.
It's a good point. We shouldn't a lot of this stuff we can't control. Yeah, so we shouldn't worry about it. We can talk about it, but we shouldn't worry about it. That's what I told my 6-year-old last night. Yeah, it's we can't worry about the stuff that we can't control. It just doesn't do anything good for us, and there's only so many things we can control. Really very few things we can actually control.
I've had that conversation too. I said, well, a bear could come in the window and trying to, and they're like, oh yeah, you're right.
And I'm worried about that now.
So
nothing we can do about the bears, kids.
Yep.
There's always a chance a bear could come through that window right now. But don't worry. Yeah. Can't do anything.
Well, I'm not worried about the bears.
No, good. All All right, let's pop on over to little Collier's market snapshot
Yes.
for Q3 2022. The Q3 almost got me saying 2023, but we're not there yet.
It is. So this report was it was shorter than some of like the Newmark report that we've covered a couple weeks ago, and some of the other reports. But it does give a good assessment and, like it says here, a snapshot of how this broader CRE markets are doing. And the upshot in general is it's not so great in terms of capital markets, not so great in terms of sales volume specifically.
Really bad.
People are not trading these properties like they were earlier in this year, really even. Now, we're still at a little bit above times like 2019, but we're not. The investment sales volume of 2022 is well under 2021. Now, the report starts with multifamily. I just wanted to hold off on that specifically because they have sections on each and talk about office real estate. They do a good job of bluntly characterizing really each of these sectors. Yep. And it says right that first sentence, office is out of favor. Sales volumes declined each quarter of the year, and Q3 sales volume is well below the 2014 to 2019 average. It says office fundamentals are challenged. Rents are still holding for the most part, but concessions are up, sublease availability is growing, absorption has been slow. In addition, the country's return to office plans have stalled, with little additional movement post-Labor Day and many investors sitting on the sidelines or pivoting capital to other asset types. Now, I've read, these snatches of headlines and subheadlines that seem to imply that maybe weaker than expected jobs numbers may bring people back to the office because they have less negotiating power to work from home.
Yeah.
But I still think that something fundamental has changed in the office market, and it's not going to get back to normal. I don't think it'll ever be the same. And there is a change and some growing pain, some real transition pain in the office market as we kind of accept that a great observable, and you can put a dollar sign on it, these people are going to be working from home, and companies are not going to pay for as big as office. I don't know what the percentage is, but it's definitely not on the margins. And I think that, even in the report, it says office to residential conversions are starting to gain more attention. How this plays out still be determined, but the conversions would help ease supply pressure on cities nationwide. I'm thinking wait, this is an office. We're talking about office to multifamily conversions in the CRE section of the office report. That's their silver lining, is that we're converting these things. Office is out of favor, and it's just, and
unfortunately, the office of multifamily, some of that is going on and will continue, but it's not easy to do because office buildings are just built differently than a multifamily. It's not, you saw a lot in the pandemic in 2020, 2021, people buying extended stay hotels and motels, converting them to multifamily. That made a lot of sense because they're already set up for living quarters, and in the extended stays, there's already a plumbing run. There's already a little kitchen in there, so it's a very easy conversion. But on an office, some of the buildings at the interiors, there are no windows. So how the floor plates are designed, it has to be conducive. So it's not just every empty office building can be converted to multifamily. Will it help? But I think just on the margins. Now, one thing I will say about office, I think that when I see office is out of favor, when I see anything that's this is out of favor, as an entrepreneur and an investor, that you start getting a little interested and excited because it's okay, that means things are selling at a discount, and it's not that people won't use offices in the future. It's just to what extent and how we're going to use them, what that demand looks like. And if you can get into an asset where there is going to be demand for, whether that's location driven, amenity driven, it's modern, or just the right use for the right business that's in demand, I think you could pick up some great assets that are going to do well over time. It's just, as a blanket statement, would just go on and buy any office building. Whereas, when I was looking at the data and the fundamentals of multifamily the last couple of years, I could make and did make the argument that you could just about go out and buy just about any piece of any apartment, and you're going to do well because of the fundamentals. Once we didn't do that, you still have criteria. You got to buy right, and you can't assume that. But you could have done that. 2012 to 2018, 19, you could have just about any multifamily property trading at a market price, and assuming you could operate it, you've done pretty well.
Yeah.
Office, not that. You have to be very tactical. And I'd say the same thing with retail.
We were maybe in the early 19th century, we were working from home, but this hasn't happened for 150, 200 years. We're talking like industrial revolution size transition. So that's why I'm a little doubtful that it's going to be a whole scale transformation. I think it is going to be a significant amount of people are going to be working from home. That's going to reduce office demand. But there is some cultural momentum to people working at the workplace.
Right. You mean pendulum switching the other way, people coming back into the office
I think there may be a counter reaction and a return to the workplace, or at least, and we're seeing that. Like, bosses want the people in the office.
Yeah, and you're seeing it from tech companies also. Yeah. Like, it's just better if we're all here most of the time. Yeah. Now, I think that the consensus, and we've talked about this in the past, but the whole idea of being more flexible, more flexibility, having some sort of hybrid option of, you don't need to clock in at 8 to 5 every single day, and we're going to watch how long you're here. At the end of the day, it's like, are you getting the work done? You need to be flexible to attract the right talent and everything. But it's not anybody who wants to just not come to the office can just not come to the office. It's like, I know you think that, but like, it would be actually nice to talk to you every once in a while and see what's going on. There
are coordinating issues. There are the ideas that, and people talk about like the soft power, like you want to be near the president, so that, and if you're at home all day, sure, you're doing your job, but like, you don't get that, like, I don't want to say like yes man vibes, but you don't build the relationships with people.
The boss might be like, who? Like, I've never set up. You have to, and thinking of Twitter and Elon Musk, and obviously controversial figure. People either love him or hate him, but
I feel sorry for him.
I don't know if I feel sorry for him, but. But what he said, I do agree with. It's like, people who are like full-time remote, like that is reserved for like exceptional work. Like, you have to be able to just crush your job, and people are like, we need to get out of this person's way because they're doing so much work, and we don't want to mess that up. Whatever they're doing, it is incredible. We can't duplicate it. We can't get anybody in the office to do half the work that they're doing. Let's keep them doing whatever they're doing. You've earned the right. Yeah. But if someone that's like, I'd really like to just, be at home more. It's like, I don't know. That it's like it's not just for everybody.
Yeah. And I think for the vast majority of people in the vast majority of workplaces, if you get people together in the same room, whether you are working on the same project or not, you're interacting with them are going to generate new ideas in a way that you can't get that if it's if you're working from home.
Yeah. In the metaverse, that's not, at some point, something, maybe, but like, it's maybe an improvement over maybe a Zoom call, maybe. But like, I don't know. But it doesn't replace everybody getting together.
Yeah, there is something that happens for sure when you're in the same room. Things get done a lot too. If you're working from home and I have and you get an assignment, then maybe you're less likely to do it than if someone's walking into your office and physically there. It's like, you can't ignore it.
Well, and how many times have you've been in a meeting, and a couple of people are either phoning in or on Zoom, and they're attending the meeting, they're there, they can contribute, but it's like not always the same. You always feel like that individual maybe not able to contribute as much, or kind of get the feel of the energy in the room and all the details. And again, the right person can get around all of that and can make up for it in many other ways, but it's just
my favorite story about this is, so I worked, it was like computer repair for the university. It was with Ben, and our boss said, I've emailed this person a bunch of times. I've called her. Really, if you want something done, you got to go to their office. And we showed up. It took them 2 seconds, got it done, and that's it. That is the example that I think of, is like, if you're standing in there, you can make things happen a lot better than if you just ping them.
Yeah, exactly. Well, because if someone's busy and they've got 10 pings and 50 emails, like, hopefully they'll get to it.
Yeah.
But it's like, for like, I'll have days where, I'm in meetings, literally, like all the calls or meetings. And, I don't necessarily, I can check my email a handful of times, but then like I check my email and I've got, 50 emails that I have to go through, and I'll get to them by the end of the day. But, it's like, but if you need something from me right now, you can pop in the office in this like 2 minutes and like, all right, I can get okay, this is a priority. We can move it up. But remotely, maybe a little bit more difficult.
So to get back to the CRE. Now, I do think that this transformation in the office market is one of the topics outside of multifamily and CRE more generally that I'm really interested in, and I'm going to be keeping follow just because I think it's interesting. And these are big dramatic changes. But to dial back into CRE in general, Colliers judges industrial real estate much more favorably than office real estate. But these properties are getting a little bit more expensive due to increased borrowing costs and still some healthy competition from investors. Retail is volatile. Hotel sales volume is shrinking. And to kind of come back to multifamily, that is, and they start their whole report here by saying that multifamily remains a relative bright spot. They say that Q3 volume was stronger than any period outside of 2021 and the first half of 2022. However, fundamentals are starting to show signs of softening. They say that occupancies, while before they have been at record highs, some form of reversion to the mean is not unexpected. I think that reversion to the mean is a little bit better to say than than coming getting back to a horrible situation. I think that the fundamentals of multifamily are strong, and we'll see. I think that we're entering a very noticeable cool down in the multifamily market, and
particularly in sales and transactions. I mean, we've been talking to brokers. NMHC is going to be going on in January. It's the National Multifamily Housing Council's annual meeting where it's like all the brokers, big buyers, everybody's there, and we're talking to brokers that come. It's where a lot of brokers come and just like roll out their deals for the year. They've been working on. Everyone, Christmas, holidays, all that stuff, and New Year's. And so people come to NMHC talking about what deals are coming to the market, what's going on, get everybody in the same place in the country. And hey, we got these brokers, we got these 10 deals that are coming out. Let's talk about these 10 deals we're going to be releasing next month or two. Talking to shops now, brokers who are like, we're going to have one deal. Like, or no deals, or 3 deals.
Yeah.
And that's it. And they're like, oh, by the way, do you want the deal? Right now? You want to buy it? And I'm like,
that's what I was thinking of when you were talking about the ways that investors or that sellers may come into the market at the end of 2023, and it's almost like this reverse of the inflation mindset where you want to buy now before prices come up. Is like, we need to get to this point where sellers want to sell now because they're afraid that prices will go down in the future.
I think we're approaching that, but with the challenge is, buyers are, even if it's like the prices are getting better, and they are, cap rates have risen 50 to 150 basis points depending on the market, and we're seeing mid 5 caps now in the Midwest when it was 4.5. But what's your deck going to look like? It's just there's so much uncertainty with a very large line item in the budget, which is your debt service, how it's going to look like, your loan to value. I mean, it just think that we thought we were going to get 65% loan to value, but now it's going to drop to 50% loan to value. Like, that might make a deal just not work or just be attractive, or you just don't have the money to bring to the table to close the deal. Our interest rate's going to be, 5.5. Are they going to be 6.5? Are they going to be 7? Are they going to be 4? Rolling the dice. Usually real estate investors are somewhat relatively conservative, at least be able to plan for that. And it's hard to be able to plan for that. And then investors understand that as well, which is why it's just hard to make sense of things right now, which is why it works out. We got deal with a loan assumption and that's
and all of these, all of this, I would say, realistic takes on the multifamily market. It is worth mentioning that in this CRE report, the one that they pulled no punches when they say office is out of favor. They were distinctly positive on the multifamily market, and so they really do expect a positive future.
The fundamentals are. I mean, again, the housing demand is still. I mean, it has been lower the last quarter because of uncertainty, but the long term fundamentals still make a lot of sense. But I would point out that they added the relative bright spot.
Yeah, that's true.
It's bright relative to office.
Yeah.
So there's a little bit of nuance, and industrial is still doing very, very well, but it can the cap rates are pretty low in industrial too.
Yeah.
So
well, and if manufacturing really does drop off anymore, then it keep happening.
Yeah. All right. Apartment list national rent report. Welcome to December.
I know. So Apartment List calls this their December rent report, but it's got the data on November rents. I call it a November rent report.
Yeah, and they're not even releasing it in December either, so I don't really know what December has to do with it.
I don't know if you read my notes. It was like yesterday, I'm working on the reports that we give to our own investors with Blake, and I almost was tripped up trying to make a graphic for our reporting because we're issuing a report on October information close to the start of December. And so I was like, well, look, we could meet it in the middle and call it a November report. We just called it a monthly report, though.
There we go.
I was like, that has an evergreen quality to it.
Because it's like we are reporting for we've got all of the closed out books for the month prior, but we also have some information for what's going on now.
Yeah.
So I think a monthly report makes sense.
Yeah.
For example, it's like, here's our variance and delinquency for that month. We know that, but oh, by the way, occupancy is now here at this point in the week.
And even reading these reports from like Apartment List and stuff is like the early ones I trust a little bit less than the ones that come in later when I'm sure that they kind of crunched the numbers, brought everything in, and so that being said, I do appreciate Apartment Lists. They're usually kind of the leader when it comes to getting these out early. They are a little bit. Comparing them to other reports that we follow, they swing a little bit higher and then dip a little bit lower. Is what I've noticed. Specifically, they're dipping lower now. Their top line numbers, we're at 4.7 year-over-year rent growth right now. Month-over-month rent growth was at negative 1%. So last month it was 5.7 year over year. This month is 4.7. We are really deep, and I mentioned this before, we're deep in a winter slump. I think it would be misleading to describe this as anything other than a cool down. 3 consecutive months of declining month-over-month rent growth, with the declines increasing as each month passes. I think we're in a new moment here. We're not anticipating a cool down. We are dealing with it right now. Granted, it's not the same cool down everywhere, but it's impossible to ignore, and it would be disingenuous to lean on the higher than average year-over-year rent growth that we're currently experiencing. 4.7 is higher than the average of 3.5 to 2.5 that they saw in 2018 and 2019. But that's not so much of a reassuring distraction. I want to know is if next month we're going to see a little bit less of a rent cool down than we saw in November. It seems like in the pre-pandemic years, the seasonal rent cooling off was was strongest in November, and then gets a little bit better. Rents go up slightly or decrease at a less drastically in December, and then things start going up. January, February, and
January is could be zero. Could be slight increase, could be slight decrease. Just no, that's going on.
Everything's out the window. It seems like, because there was so much growth in 2021. I don't know what the reaction is going to be to it. I still don't think the economy is in such a place where it's like really going to. Seems like it's a multifamily issue. Now I know the economy is playing into this, but I don't know. It's hard for me to imagine anything else. This is just like a rubber band effect from the rent growth previously, and we're kind of reverting back to an absolute mean, rather than we're in a recession. That's why rents are doing so bad.
I think it's a combination of a lot of factors. I think we have a decrease in demand, people not moving around as much, people being more budget conscious. Then there's also seasonality that's thrown in there as well, a little bit of reversion to the mean. But without a doubt, I mean, we've got some major oscillations going on, and kind of like a sawtooth waveform going on, forming. And think about just this dramatic shift in just a few months' time. I mean, peaking back in June, being 1.5 essentially rent growth in a single month, and then just a few months later being all the way at negative 1%.
Yeah,
that's a big shift, and again, especially if you had 10% rent growth being plugged in this year, you're good chance you may not be getting it right now. Yeah.
Now, this is where I throw in another caveat, because and this is realistically, I think that this is a productive report. It is a reality check that I think is really important to kind of signal to people. That being said, and again, I don't want to reduce any of this. It's different market to market. A lot of this rent decrease is due to the weight of previously high-flying markets that now aren't doing so well.
Yeah.
Now, if you want to talk about the strong performances, they really highlight the Midwest.
I was going to say, I mean, like the headline I'm immediately seeing here is Midwest, best rent growth in the country.
Yeah.
Number 1, Cincinnati. Number 2, St. Louis. Number 3, Indy. 4, Columbus. 5, Kansas City. Matt, correct me if I'm wrong, but I mean, these are essentially like cities, maybe not St. Louis as much, but these are all like great fun markets.
Yeah. It's the exact same stuff that we were talking about 2 weeks ago.
Yeah.
And these are, it's gratifying, but it's also, I don't want to seem like we're jumping on these like we always have. We've been...
This is a tortoise and hare. A tortoise and hare type situation.
Yeah. And there are some moments where, and this is what I said beforehand, it's like we're flyover country and we just don't get the news that the economy is doing bad. So we just keep kind of working at it.
Yeah, hasn't affected us.
We thought we were having success.
But you guys have job losses? Oh, that hasn't hit here yet. The trend has.
Yeah.
It's interesting, like you can look at trends that go on like New York City, and it takes 1 to 2 years, up to 4 years for some of those trends to percolate up down to the Midwest or whatever, and like a broader, whether that's like a restaurant that's what I see it off is like concepts, like restaurant concepts of like, hey, they're opening these new really cool, Peruvian the Peruvian restaurants are the rate. Like, you haven't go to Peruvian restaurants every week, and then it's like, oh well, we only have one, and then in 2 years we'll have like 30 Peruvian restaurants. Yeah, but same thing with rent growth and job losses and economic activity for the good. So we miss out on, some of the fresh trends and maybe some really fast growth right away, but we also don't experience the losses, and we avoid some of the bad trends and fads.
Yeah. That's what I was thinking too. Is like we're lagging. And this is just in terms of like multifamily performance. We are, when things were going good, we were going. It's not like we missed the great run up in rents in 2021.
Yeah, I mean, some suburban Midwestern markets had higher rent growth than a lot of Sunbelt markets.
I think that it really does boil down to it's cheap to live it's cheaper to live in the Midwest.
Yeah.
And we didn't see the rent growth. We didn't see the single family home prices. The rent to income ratio that, I talk about this every month, but it is among the lowest in Kansas City and Indianapolis. So it's housing costs and cost of living. And I'm not saying that there is a bunch of people that are going to be flooding into these markets because everything else is expensive, but I am saying it supports continued stable growth when the cost of living is already that low anyways. It's not, people's backs aren't against the wall to the extent that they are in other markets.
I'd agree. And I mean, they kind of back that up with, at least comes on the Sun Belt of this headline of, some booming Sun Belt markets they've plateaued, and some of are seeing declines.
What was the tops for declines were Vegas is in there, Phoenix in the last 12 months at least, Vegas, Phoenix, Sacramento, Jacksonville,
Tampa.
It's these are ones that were being celebrated and still, ultimately probably have some great rent growth that they're going to see.
Oh yeah, over time. I mean, like Phoenix is like going to bounce back. I mean, Phoenix got in Vegas, some of the same markets got completely crushed in great financial crisis, and they came back being awesome markets. It's just again, that's where it's like, you can get screwed up with timing in some of those markets because they're so volatile.
And a lot of these, and a lot of these markets, they big populations. And when a market with a big population sinks, that's going to draw the national average down.
Good point.
And so there's some smaller markets in the Midwest that are growing. We just don't have the population that's going to affect the average. So it does seem like a lot of these are outliers. But everywhere's different, and that's the first.
Yeah.
So back to what we talked about really early in this discussion, and you talked about time as a way to kind of figure our way and make the right decisions when it comes to investing. But I think that this is where I'm thinking is which markets are doing great, and during this time, I think that it's hard not to see some success in the Midwest, especially if you look at it in the greater context and its performance early in the pandemic when everything was rough. Midwest was going stable.
Yeah.
And now it could rhyme with what happened, early in the pandemic where people relied on that stability in the Midwest.
Wow. I was like, what's this red? I was like, man, first I was like, wow, what is this big dot? Oh, that's Indianapolis. Like the only little bright spot right now.
Yeah.
Like you could almost say the country. I mean, this is the biggest little circle of growth right now that I can see.
Yeah.
Then I'm like, what's this little red spot right here? Like, oh, that's South Bend. Oh, we've got a nice asset up there.
That's right.
People sometimes are like, what are you doing in South Bend? What are you going to these markets? I've never heard of these markets. And then they're like, I just saw a report that rent just rose by 20% in that Midwestern market. And I went to the Sun Belt and paid a cap rate that was like multiple times lower, and I'm not getting any cash flow.
I don't even want to characterize the Midwest as this. It's not the roads are paved with gold place.
Yeah,
it's
no, our roads
place.
aren't even that great here in Indiana.
It is a regular place where people live, and turns out it's not bad.
Yeah, exactly. And like I was talking to Addison, and that he's like, the perception of Indiana is like, especially from Chicago, is that like, other than maybe some of the cities, it's like mostly hicks, and like why would you live in Indiana? And then you kind of come here and it's like, all right, this really isn't that bad. It's actually kind of nice and easy to get around. It's easy to live. Things are affordable, and it's kind of a nice place. And
I was talking to a friend just so he travels all the time. He's like, you know what? I was going through my head, and there's a lot of places that can get disqualified, especially for cost of living.
Yeah.
But Indianapolis is a good, and other Midwestern cities like this, it's pretty good.
Unless it's like you need to be in a place where you have access to the ocean, or you need to go skiing every day,
or a mountain,
that's what I'm saying, a mountain. But like if you need those two things, like every day, you're gonna go in the ocean every day. Because like the money we save living in Indianapolis, we can fly wherever we want and go to the ocean whenever we want. Now it's not exactly the same, but you pay such a premium living in those other locations, and that's not a priority for a lot of people. They don't care about a mountain. They don't care about needing to go to the ocean every single day.
Yeah.
But it's a great place to raise a family. It's a really good economy. It's business friendly. It's a good culture. Good community. Relatively diverse. Like most cities, and people stay. It keeps people sticking around. And again, it's like the Midwest, and I've told this story multiple times. Like you'll go to these big national conferences, and they don't even talk about. They don't even it doesn't get mentioned.
Yeah.
Like they don't even talk about it. Like we're going to do like a national multifamily market report. And they're like, we'll talk about the Sun Belt for 30 minutes. Now let's talk about, we'll talk about California, and we'll talk about, the Mountain West a little bit, and then the Eastern Seaboard, and that's it.
Yeah. Yeah.
I'm like, what? And like literally I've been at major national conferences where like it was left out. And part of me was like, well, that's too bad. I was looking forward to the report. On the other hand, I'm like looking around, seeing a room of like buyers from all around the country. I'm like, you know what? Fine. I'm going to go buy the real estate in the Midwest.
Yeah, people live in, and there are enough investors where the market is relatively liquid. It's not like a dust town from the investment standpoint.
No.
So it is pretty ideal if you want, and again, this is kind of the ethos that we were trying to establish earlier is if you kind of stability and kind of a measured decision. It really fits well with the Midwest, and I think that what we're experiencing now, it shouldn't be ecstatic. I don't think it is ecstatic growth. It's just stable.
We're the tortoise. We're just moving along.
Yeah.
We're just cruising, and then in times like this, when everything else drops, we continue to move forward. I mean, again, look at this map. Is there any other markets that you're like, I want to know what that is? I mean, obviously there's great markets all over the place. And here's another piece of red down here. I mean, of course, it's in Florida, but see
Yeah, we're at Fort Myers, yeah.
But so okay, I can go pay like a 3 or 4 cap in Fort Myers and get no cash flow, maybe some good rent. Good, since 40%, that's really good. Or I go to South Bend, or like I would like Granger rather than South Bend. South Bend's got some not great areas, but some of the suburbs around are very affluent. Obviously Notre Dame, a lot of manufacturing stuff in the area. Yeah. I'm gonna get like a mid 5-6% cap rate, crush cash flow, get good rent growth, and everybody's happy, and everyone questions you while you're doing it, but it's not like vindication, but it's like it's nice to see that, like, okay, what our kind of assumptions and thesis were are staying kind of true to the form. It's like, we say, the Midwest is stable, keeps going, it's not volatile. And we say that because of his history and experience. Yeah. And then when it happens again, it's like, this is exactly what we kind of were talking about and what we've experienced. And
I think that it almost engenders a kind of attitude and perspective on the market where you're a little skeptical of attention being paid on these markets. Like, well, is this just setting this up for a steep decline later? Yeah. So like they don't need to pay too much attention to. Yeah. As much as we're seeing this attention, I don't want too much, because then it gets a little more exuberance.
Everyone's going to be busy at the holidays. No one will see it. Unless we're getting more subscribers to the Gray Report, though. Yeah, which reminds me, if you're not a subscriber to the Gray Report, make sure you press the subscribe button and leave a comment as well, because we'd love to hear your opinions on, be like, hey, no, you guys, Indianapolis actually does suck, and you guys are dumb, and I'm investing in California because of the sunshine and surfing, which is, like, love California, love sunshine and surfing.
And there are ways to fail in any market,
100%. And to be successful in any market. I'm from the Midwest. I'm from Indianapolis. You're from Indianapolis. Yeah. This is what we know, and it happens to be a great market. Yeah. And so, but the reason why we can move things forward, not just because Indianapolis is a great market, is because we know the market and we know how to execute in it.
Exactly. Yep.
Bottom line. Totally agree, Matt. Obviously, the market doing well helps us out.
For sure.
You can't have enough bullets in your magazine. So
can't
do it. Can't do it. Okay. Well, Matt, we got a real page report?
Yeah,
I just want a real page report?
Yeah, just really quickly. Now, we don't have to kind of settle in on this as much, but it talks about loss to lease. Yeah. And this is by Carl Whitaker at Real Page. And loss to lease is a measurement of the difference between the renewal rate for apartments and the rate of new leases, with the idea that property managers typically discount renewals. We talked about this before. You don't, to save the cost of turning it over, to not encourage a situation where someone could move into a new unit in the same building and get a cheaper rent every year. I thought that was kind of an interesting hypothetical situation. But they want to they have this discount. Now, how much are the discounts? In some cities, discounts is really small, but in others, there's a sizable gap. And
between market and loss lease and effective rent.
Market
and renewal rates.
Mm-hmm. Market and renewal rates. Now, one, maybe it could be a factor of the market itself. So you always have this tight, low, small gap. But some, it's a product of the past performance. If you've seen a lot of rent growth, maybe loss to lease is larger. Now, you can correct me there, but that seems to be kind of a general rule. And these are some of the same markets that we've been talking about earlier in this report. Kansas City, we've mentioned that. Indianapolis, I think we've talked about that before. There's an interesting momentum to these Midwestern markets during uncertain times. I don't know if it's logistical importance or what, but I think we've covered all the reasons that these Midwestern markets continue to do well, and this loss to lease, I think, is almost like a signal that you got some runway. There's some rent growth to come as renewal rates catch up to the increase in effective rent.
Yeah. It's interesting just the changes in just the last couple of months, because kind compared to pre-pandemic. Pre-pandemic on renewals, because rent growth, on average was about 3%. So it wasn't like dramatic. It wasn't hundreds of dollars. It was like, tens of dollars usually. And so your typical renewal would often be like a nominal amount that typically was less than the market increase because you wanted to maintain occupancy, but you wanted to have some rent growth. So, it would often be a flat $25 on renewals, $10 on renewals, maybe $50 on renewals, but that would kind of be a lot. Then when the pandemic rolled around and we're at 100% occupancy or high occupancy, and you just have wait lists starting and the market rents are increasing so significantly. And then you've got this big gap on the folks that had signed a lease back in 2019. They were paying $1,000. Now your market rent's $1,500.
Yeah.
And you got people saying, I want to rent that apartment for $1,500 and I'll pay $1,600. So it's hard from a business perspective to say, I know you rented last year for $1,000. The new market's $1,500, $1,600, but I'm only going to increase your rent $25. And that would be really nice. But that difference between that now $1,025 and the $1,500, you're $475 of loss to lease. Because that's what you're giving away to the market. You're not taking advantage. You're leaving that money on the table essentially. Some of that naturally happens. Like if you increase your market rents and your effective rents are down here, well, you immediately increase your loss to lease because there's like a bigger gap between the two.
Yeah.
So you want to know how it looks like in context. But now the pendulum is shifting the other way of where demand is lower and where, again, 6 months ago, a lot of operators are saying there's so much demand, renewals, just set them at market. Not even like it's like whatever the market, it's like, hey, you want to stay here? We'd love to have you. Yeah. But you have to pay what everyone else is paying. Yeah. The new people who are living here are paying $1,500. Again, we want you to stay here, but it's going to be $1,500. And then you make some exception, maybe some long-term residents and you say, okay, $1,250 this year, but next year it's going to go to $1,500. Yeah,
that's what I was going to say. That's a difficult decision for property managers and to figure out, people living there and they've gotten used to renewals set amount, and now I wonder if people are thinking about almost in installments, not maybe taking all the big rent increase on one renewal, but maybe over the next 2 or 3 years.
Yeah, but people, we don't want to sign a 2-year lease. I want to sign a.
Oh no, I mean, that's. I
don't want them to. No one. 2 years is tough because how do you know? What if rents increase another, which they're not going to? What if they increase another 10%?
Yeah.
Then you've lost that. Then you try to sell it to people. You've got these long-term leases at low rates, and so it's
or maybe even just communicating to residents that like this is what rents are. This is what rents are going to be. Yeah, it's hard.
Often the conversation is, I know it's a big increase. Mm-hmm. Here's a market survey. Here are your other options. Everywhere else is at $1,600 and $1,700.
Yeah.
Our new market's $15. We're only going to bring you to $14. So it's $100 below our current market, $200 to $300 below the rest of the market right now. And that's just the reality. Mm-hmm. What's tough is when it's a resident that's been there for a long time, or you bought a property from an owner that's owned it for a long period of time, and someone's like, their rent has been raised for 15 years.
Yeah.
And so you do make exceptions with some people because it's like, look, the business plan isn't going to be materially affected by this one resident that's been here for 15 years. Mm-hmm. Okay, well, we're going to have to increase their rent a little bit, but maybe it's not $500. Maybe it's not to $250. Maybe it's nominal. We want you. But other times, you do have to make a business decision because you got a lot of those. You can't just say, you have to ask yourself at the end of the day, you want to build the best community, treat everybody right. Mm-hmm. But at the end of the day, it is a business. We're not providing, free or subsidized housing. Yeah. There is subsidized housing and affordable housing for that, but that's not what
people that the new renters would pay that themselves.
Yeah.
And now I do. So I sympathize with that situation, and that's why I think that communicating and being upfront with residents, not so it's surprise.
Communication is key. And it's where it's like easy to do, easy to forget to do.
Yeah.
But it can make all the difference. At the end of the day, it's not much effort, and it can people, as long as they're informed, They make these people complain about it, but it's a lot better than not knowing what is going on.
Yeah.
So, end of the day, Matt, this is a great set of reports. I do think we are in a new era. Whether we know what to call that era, what it's going to look like, the next 3 to 6 months are going to be absolutely fascinating, as this last 3 to 6 months have been absolutely fascinating. Are we going to have more deals next year? I certainly hope so. I'd like to, but we don't know. We've got a couple really exciting opportunities right now in the Gray Fund. We're closing on a property, Sycamore Terrace, next week on Tuesday. We're really excited about that. A couple pending acquisitions, hoping to be closing on a property in Bloomington now, kind of probably early next year. But that one, it's an assumption. So like we've talked about, this interest rate uncertainty and volatility. None of that on this deal because we're assuming like a 3.6% interest rate. Yeah. So that's few and far between. That's a deal that makes like a ton of sense, and we're buying at a good value, good price. But right now, the rest of the year, not sure. We were having a budget meeting. We're like, I don't think we should budget buying anything next year. We're going to try to if it makes sense.
Yeah.
But what happens if we don't?
Yeah.
That's why you take the steps to build the business the way we have, so we can do that. If you do want to get funds allocated before the end of the year, it's going to be tough as we're closing next week. We are going to have opportunities at the first of 2023. So if you're an accredited investor, we'd love to have a conversation with you, whether you're a current investor or you've just been watching the podcast and YouTube show and you're like, all right, I want to give these guys a call to see what the deal is. We'd love to talk to you, obviously. Just kicking the tires, well, we'll talk to you too. It doesn't matter. But make sure you're subscribed. Leave a comment. Thumbs up. Mm-hmm. Thumbs up. Thumbs down would be not nice.
We got a single thumbs down last week. I'll find you, and I'll make it better for you.
Is that Addison's fault?
No way. It wasn't me.
All right, everyone. Well, thanks again for watching The Gray Report. We will be back with you next week. And again, make sure you're subscribed. Sign up for The Gray Report newsletter. You can go to graycapitalllc.com/newsletter. And for information about The Gray Fund for accredited investors only, you can go to gray.fund. Type it right into your browser. Pop right up. Got information, links, forms, videos. We've got the full Monty, everything, the kit and caboodle, all that good stuff. So catch you next week. Talk to you soon. Later.